Hi, everybody. Scott Riley, the Market Update Desk, February 7th. Got the jobs report today, did a brief update early this morning. Wanted to go into a little more depth on it. So, in review, the jobs report showed that 143,000 jobs were created in January, which is about 20,000 less than the expected mark that the street was expecting. Now, what was really interesting is the previous 2 months revisions were upwards. We thought we might actually get a downward revision, but it was revised upward by 100,000. Now, this added definite strength to the report, especially being um, unexpected like that. Now, the media made a lot of noise, a lot of comments. I was watching CNBC this morning about one specific data point: average hourly earnings. Now, that showed a big increase to the top side. The market expected 3/10 up, and it was up 5/10 in January. Now, this caused the bond market to do a sell off this morning. It is thought that when earnings rise, individuals will spend more money, which can be an indicator of inflation on the horizon. Looking deeper, though, the hours worked fell from an initial reported number in December of 34.3 hours to 34.1. And what really matters when we look at all this is what the take home pay is. Average weekly earnings only rose by 2/10 and are up 3.8% year over year. Additionally, the drop in hours is another way companies can eliminate costs without letting people go because you're having them work less. When you extrapolate how many jobs the 2/10 drop in hours account for based on output in the economy, it would drop about 1 million jobs. So, yes, there is an aspect that you've got to look at for average hourly earnings, but you need to really look at average weekly earnings because that takes into account hours worked. The labor force participation rate did increase by 2.197 million, but that's because there were more jobs created than the rise in the labor force. The unemployment rate from that disconnect between jobs and labor force had the unemployment rate fall from 4.1 to 4%. This also applied some pressure on the bond market. That's why we're having a little bit of a bad day. But the reliability of these numbers are really in question, and we're not going to really know more until we get the QCEW, the quarterly census on earnings and wages. We think we're going to see that upward skew get corrected to a downward revision fairly significantly. Now, there will be some revisions to this data eventually that will help the bond market, but we're never going to get the improvement back in the market that we lose initially from these numbers. So next week's not as busy of a week. The main thing is going to be on Tuesday. We get Chairman Powell's semi-annual testimony before Congress. So that's going to be a very important thing. The traders and market are going to watch his commentary. Today we do get a couple Fed speakers. I believe it's Kashkari and Mary Daly. I'm probably not going to have an update on Monday because I do get to have more work done to my knee. Unfortunately, it's going to put me out for Monday. If I can, I'll quick do an update, but we'll see. Hope you enjoy the information and the breakdown of the data. The Market Update Desk is your original singular market news source for West Michigan. Give us a call. We're on call all weekend, 616-293-2189. We'll help you with all your mortgage needs.